Hello and welcome. Today we're going to pull back the curtain on one of accounting's most powerful, but let's be honest, often misunderstood concepts, accrued expenses. Now they might sound a little technical, but I promise you they are the absolute key to unlocking the true story behind a company's profit and seeing its financial health with some real clarity.
All right, so here's what we're going to cover. We'll start by digging into the illusion of profit. Then we'll get to the core principle that really governs all of modern accounting. From there, we'll define these expenses in weighting, see how they're actually put on the books, and then, this is the fun part, decode how they reveal the true quality of a company's earnings. And by the end, you'll see how all this gives you a kind of financial X-ray vision.
So first up, let's just tackle this fundamental illusion in business, this idea that cash in the bank is the whole story.
I want you to think about this for a second. Let's say a company makes $1 million in sales in December. Looks great, right? But what if they haven't gotten the bills yet for the electricity they used, or the employee bonuses they owe, or the consulting services that helped make those sales happen? Is that $1 million profit real? Well, not exactly. This creates what we call ghost profits. It's this artificial surplus that just vanishes the second those delayed bills finally show up. And this slide really gets to the heart of it. You've got these two different worlds of accounting. On one side, there's cash accounting. Super simple. Money in, money out. But accrual accounting, which is mandatory for any public company, it's going for something much, much deeper. It isn't designed just to track your cash. It's designed to reflect the economic reality of the business.
So how do you capture that economic reality? Well, accountants rely on this one foundational rule that makes the whole system work. It's called the matching principle.
And look, this isn't just some random rule somebody made up. It's a principle of fairness. It just makes sense. It says that the costs you have to pay to earn your money should be recognized or matched in the very same period you earn that money. It's all about creating a true and fair picture of how you performed in a specific window of time.
And here's the perfect way to think about it. If you don't record that December electricity cost in December's financial statements, you're making your December profit look way better than it actually was, and you're hiding a debt you owe. The matching principle forces you to account for that cost right away, giving everyone a much more honest look at how the month really went.
Okay, so with that logic in our back pocket, let's meet the actual tool accountants use to make it all happen. This is where we get to the accrued expense itself.
To put it really simply, an accrued expense is a cost the company has already incurred. They've already used the service, they've already received the goods, but the paperwork just hasn't caught up yet. You know, the bill is still in the mail, but the expense, that is already real. The company owes that money, and it has to be recorded right now.
Now, this brings us to a place where a lot of people get tripped up, the difference between an accrued expense and accounts payable. And as you can see here, it all comes down to one simple thing, the invoice. Accounts payable is for bills you have received. Accrued expenses are for costs you know you owe, but you're still waiting for that formal bill to arrive. That's it. That's the dividing line.
And we're not talking about some weird exotic accounting stuff here. These are very common everyday business costs. Think about salaries earned by your employees in the last week of the month that you're going to pay them in the first week of the next month, or the electricity you used all through December, or the interest that's quietly building up every single day on a business loan. These are all classic accrued expenses.
All right, so now let's pull back the curtain and actually see the simple two-step process accountants use to make this concept a reality in the books. It's something called an adjusting entry.
It's a really clean cycle. So at the end of the month, the accountant makes an entry. That entry recognizes the expense on the income statement, and at the same time, it creates a liability on the balance sheet. Then next month, when the actual bill comes in and gets paid, they just clear out that liability. The expense is perfectly matched to the right period, and the books stay perfectly balanced.
But here's the thing, this isn't just about keeping tidy books for the accountants. This is where it gets really interesting for investors and for analysts, because accruals give you this critical window into a company's financial health and maybe even its honesty.
You see, because an accrued expense is recorded before an invoice shows up, it often has to rely on an estimate made by management. And wherever you have estimation, you have judgment. And professional analysts, they pay very, very close attention to this, because a company's pattern of accruals can tell you a whole lot about the quality and the sustainability of its profit.
In fact, there's a really powerful tool that professionals use to measure this. It's called the Sloan ratio. A researcher named Richard Sloan developed it back in 1996. The formula, it essentially measures what chunk of a company's net income is made up of these non-cash accruals versus actual real cash from its operations.
And here's basically how you interpret it. A low ratio, let's say below 10%, that suggests the company's earnings are high quality, they're backed by cold, hard cash. But a ratio up above 15%, that can be a pretty big red flag. It suggests the company's relying really heavily on these accruals to generate its profits, and that might not be sustainable in the long run.
And this quote right here, this is the original finding that really shook up the investing world. Sloan discovered that investors, they often get dazzled by big earnings numbers, right? But they fail to check if those earnings are actually backed by cash. And when those higher accruals eventually reverse in later periods, the earnings can fall off a cliff. Investors get caught completely by surprise, and it leads to lower stock returns.
Now, just to see the sheer scale of these numbers, let's look at a real-world example from Apple's 2024 financial statements. Just look at their other current liabilities. That's where a lot of accruals are bundled up. It jumped by nearly $20 billion in just 1 year. And you can see a huge piece of that is specifically broken out as income taxes payable.
And here's why. A single event, a ruling from the European Commission, forced Apple to recognize, or accrue, a one-time income tax expense of $10.2 billion. Think about that. That one journal entry, with no cash changing hands yet, instantly created a massive new liability on their balance sheet. It's the perfect illustration of how a non-cash event can have a colossal impact on a company's financials.
So let's bring all this together. Why does getting a handle on this one concept really give you a whole new level of financial intelligence?
Well, it's because when you understand accruals, you're no longer just looking at the cash that's coming in and out of the door. You're seeing the business as it truly operates, from one period to the next. You can see the obligations it's building up behind the scenes, and you can see the true costs of its revenues. It is literally like switching from a regular photo to an X-ray.
So, to wrap up, here are the key things to remember. First, and maybe most importantly, profit is not the same as cash. Don't ever forget that. Second, the matching principle is that rule of fairness that makes sure expenses get put in the right period. Third, accruals are really just those expenses that are waiting for an invoice. And finally, a high level of accruals can absolutely be a warning sign about the quality of a company's earnings.
So I'll just leave you with this question. The next time you see a company report a big profit, ask yourself, am I just seeing a snapshot of its bank account right now? Or by understanding its accruals, can I see the full movie of its actual performance? That's the power this knowledge gives you. I hope you found this helpful.